I talk to a lot of founders of early stage tech services firms that often wonder what benchmark should they be measuring themselves against from a financial perspective. Meaning, if at some point they were ready to sell their business or take on investment, what are buyers and investors actually looking for? And for some time in the industry, there's been this rule of thumb that the best run and most investable service companies are what are called 20/20 businesses. And this stands for 20% CAGR, or compounded annual growth rate, which is the average annual growth of the company over the past few years, and 20% EBITDA, or the profitability of the business. 20% growth, 20% profitability. And generally, 20/20 businesses command the highest valuation. So when it comes time to sell or take on investment, they're going to be worth quite a bit more than a business that isn't growing quite as fast or isn't as profitable. Now, there's a couple caveats to this. If your business is growing faster than 20%, then investors are going to be more apt to look past that EBITDA margin as long as it's still healthy. One litmus test is to ensure the two numbers add up to 40 or more. This is often referred to as the rule of 40, and it's a popular standard for SaaS companies that are not yet or barely profitable. But I will caution you on managing your business to too low of a profit margin in favor of growth at all costs. Our businesses don't grow like SaaS companies. They're typically lumpy. They typically grow on the backs of large evergreen customers that spend with us year over year. And it's hard to predict when those evergreen customers are going to come in or potentially go away. So it's much better to manage your business to a high teens, low 20s EBITDA margin so you can ride out those waves. I remember back in the early 2010s when I pivoted Solstice to be one of the first mobile boutiques, there was another firm in our sector who we were competing against. And we were both scaling rapidly, but Solstice was tempering that growth by maintaining a healthy EBITDA margin. Our competitor foregoed profitability for growth at all costs. And since the business wasn't profitable, the founder brought on a private equity firm as a financial partner to help provide the capital as they scaled. And over time, the founder became more and more reliant on that financial partner. And eventually, he lost control of the business and he was pushed out. Now, I'm not saying that's the playbook for every private equity firm or any private equity firm. It's just what happened in this case. But the hard truth is this: own the profit line and you'll own the company. Now, conversely, too much profitability also isn't great. I talked to one founder recently who had been meticulously managing his business to a 37% EBITDA margin for the past 5 years or more. And his problem was he wasn't growing and he wasn't sure why. And I told him he was taking home 17% of his revenue that should be put back into the company for growth. You can't grow if you don't invest in the business. Now, there's one more big 20 that I'd like to tell you about, and that's 20% employee attrition. If you're growing your business at 20%, it's critical that you keep your employee attrition below 20%. If attrition rates are ticking over 20 and you're growing at 20, then you're effectively replacing 40% of your workforce every year. And it's really hard to maintain a strong, consistent culture if that's the case. So be sure you're investing in employee experience enough so that your attrition rate never spikes above 20%. And similarly, attrition rates in the low single digits often is unhealthy as well. A certain level of turnover and exiting of low performers is important to maintain that culture of excellence. Growth can mask a lot of mistakes. Never compromise on quality. We'll talk more in future episodes about how to get 20% consistent growth and how to manage to that 20% bottom line and less than a 20% employee attrition. But for now, just remember, 20-20-20 is your ticket to creating a breakthrough services business. I'll see you next time. My name's Jay Schwan. I spent the last 20 years building a $500 million market cap tech services company. For my next chapter, I've created the Second Mountain. It's a firm focused on giving back to the tech services community by coaching and investing in early stage tech services founders. If you want my free masterclass sent directly to your inbox, just email subscribe@thesecondmountain.io. Let's go.